Every generation of investors experiences the same shock. A sudden market crash, headlines filled with fear, charts plunging downward, experts arguing on television, and millions of ordinary investors asking the same question: how did this happen again? If you zoom out far enough, you'll notice something unsettling and oddly consistent. Major financial markets tend to experience serious declines every 7 to 10 years. Not exactly on schedule. Not always for the same reason, but often enough to make this pattern impossible to ignore. The dot-com crash. The global financial crisis, the COVID panic, regional banking collapses, liquidity shocks, debt crises. Different triggers. Same emotional result. Today's video is not about predicting the next crash. That's a losing game. Instead, we'll answer three far more important questions. Why do markets fall in cycles every 7 to 10 years? Why do most investors fail during these periods, even when they know history? Markets don't collapse suddenly. They weaken quietly first. During good times, stability feels permanent. Economic growth looks predictable. Companies report strong earnings. Credit becomes cheap. Risk feels manageable. Confidence slowly turns into complacency. This is where the illusion begins. When markets rise for years, investors start believing that the system has learned how to avoid crashes. New technologies, smarter policies, faster data, better regulation, all seem to suggest that volatility is a problem of the past. But stability itself creates instability. Cheap money encourages excessive borrowing. High asset prices reduce future returns. Risk gets pushed further out and ignored. Eventually, small problems pile up beneath the surface. Debt levels grow faster than incomes. Speculation replaces investment. Efficiency replaces resilience. Nothing breaks immediately. Until something does. A rate hike. A liquidity freeze. A geopolitical shock. A banking failure. The system doesn't collapse because of one event. That event simply exposes years of hidden fragility. This is why crashes feel sudden, even though their causes were building quietly for a long time. The 7 to 10 year cycle isn't magic, it's behavioral. Human psychology does not change, even when technology does. After a crash, fear dominates. Investors become cautious, regulations tighten, risk is avoided, balance sheets are repaired. This phase creates stability. As memories fade, confidence returns. New investors enter the market. Leverage slowly increases. Risk tolerance expands. Eventually, fear is replaced by optimism, and optimism turns into overconfidence. This process takes time, usually several years. Credit cycles, business investment cycles, and human memory cycles all overlap. When they peak together, markets become vulnerable. At that point, even a small shock can trigger a large reaction, because the system is already stretched. This explains why crashes are not evenly spaced, but often cluster around the same time horizon. The cycle is not driven by numbers alone. It's driven by emotions. Fear, greed, forgetfulness. And that is why no amount of data will ever fully eliminate market cycles. Most investors don't lose money because markets fall. They lose money because of how they react. During crashes, logic disappears. Losses feel personal. Fear becomes physical. The brain switches from analysis to survival mode. People sell not because it's rational, but because pain demands action. Ironically, this is when future returns are highest. The average investor buys near peaks when confidence feels safe, and sells near bottoms when fear feels unbearable. This behavior is well documented across decades of data. Markets recover, but investors often don't because they exit at the worst possible moment. The key mistake is thinking that volatility equals danger. In reality, volatility is the price you pay for long-term returns. The market doesn't punish patience. It punishes emotional decision-making. You don't need perfect timing. You need a system. First, accept volatility as normal. Crashes are not failures of the market. They are features of it. Second, build diversification before you need it, not during the storm. Third, keep liquidity. Cash is not trash during crashes. It's flexibility. Fourth, rebalance. Don't react. When assets fall, your strategy, not your emotions, should guide your decisions. Finally, remember your time horizon. If you don't need the money tomorrow, short-term volatility is noise. The average investor doesn't win by being smarter. They win by being calmer. Markets will fall again. Not because they're broken, but because they're human. The cycle will repeat. The fear will return. The headlines will scream. The question is not whether it happens again. The question is, will you panic or will you be prepared?